For more than 300 years, one institution has quietly influenced Britain's direction and, at times, the wider world. The Bank of England is often viewed today as a standard central bank adjusting interest rates, managing inflation, and keeping the financial system in order. But its true impact reaches far deeper. From its creation in the late 17th century, it became an engine of government funding, an architect of empire, and a gatekeeper of credit. The real story of the bank is the story of how money shifted from something tangible to something controlled, shaped, and issued at will by a small circle of decision-makers. The bank began during a moment of desperation. In 1694, England's government was financially exhausted after years of conflict with France. With no gold left and lenders unwilling to help, a new solution emerged. A group of financiers would lend money to the crown, and in return they would form a national bank. What they introduced was revolutionary. Instead of issuing money backed strictly by precious metals, they issued money backed by government debt, future taxes, future income, future obligations. For the first time, a country could spend far beyond what it physically had. Credit became the engine of national power. This arrangement transformed England's capabilities. With access to constant borrowing, the country could outspend its rivals, expand its reach overseas, and fund the early stages of industrialization. But it also meant the economy became increasingly dependent on debt and the institution managing it. The Bank of England gained the ability to create credit, set the price of borrowing, and influence who received financing. The modern financial world emerged from this shift. Governments no longer needed treasure chests of gold. They needed confidence, credibility, and a central bank capable of turning promises into money. Throughout the 18th century, the bank's influence deepened. During moments of financial panic, it became the lender of last resort, providing emergency funds to private banks to keep the system from collapsing. That role came with immense leverage. By choosing when to expand credit and when to restrict it, the bank could shape the timing of booms and tighten the screws during downturns. While the public was told this was necessary for stability, the bank's control over money quietly expanded. The Napoleonic Wars exposed the true scale of the bank's power. Faced with soaring military costs and dwindling gold reserves, the government suspended gold convertibility in 1797. For more than 20 years, the country operated on paper money, with no metal backing. Inflation surged, savings eroded, and everyday people bore the consequences. Yet war spending continued uninterrupted because the bank could simply create more money. When gold payments eventually resumed, it became clear that monetary rules could be rewritten whenever required. Control over money was not fixed. Cliffstad was flexible for those who managed it. By the mid-19th century, the bank sat at the center of global finance. London became the world's financial hub, and the bank's decisions influenced trade, investment, and credit across Europe, Asia, Africa, and the Caribbean. A small shift in interest rates could determine whether businesses thrived or crumbled, whether colonies received investment or suffered droughts of capital, and yet the bank itself operated with remarkable secrecy. Its meetings were closed, its discussions undisclosed, and its governors unelected but immensely powerful. Financial crises repeatedly revealed how dependent the system had become on the bank's judgment. Throughout the 1800s, major crashes struck every few decades. Each time, the bank stepped in to stabilize markets, and each time its authority grew. Many of these crises were triggered by credit expansions or contractions influenced by the bank itself. Yet because it provided the rescue, its role was seen as protective rather than causal. Over time, the governor of the Bank of England held more immediate economic power than most politicians. He could raise or lower interest rates, alter the availability of credit, and influence the economic well-being of millions. The early 20th century brought new challenges. Maintaining the value of the pound became a national mission, even when it harmed domestic industries. The bank repeatedly prioritized a strong currency over employment and wages. Its policies served creditors and bondholders more than the workers who felt the effects of recessions. Ordinary citizens saw the bank as a symbol of stability, unaware of the quiet debates and secretive decisions shaping their lives. World War I revealed both the strength and fragility of the system. As war erupted, panic hit the financial markets. Once again, gold convertibility was suspended. The bank pumped money into the system to keep it afloat, and funded the war effort on an unprecedented scale. By the end of the conflict, Britain's debts had ballooned, and its gold reserves were nearly depleted. When peace returned, the bank faced a critical question: restore the pound as old value, or adjust to a new economic reality. Under Governor Montague Norman, Britain returned to the gold standard at an overvalued rate, attempting to restore its former prestige. The move backfired. British exports became too expensive, factories closed, and unemployment soared. Norman believed protecting the currency mattered more than short-term hardship, but the decision inflicted lasting damage. Meanwhile, Norman formed close ties with the Federal Reserve in the United States, coordinating policies in secret. This early attempt at global central bank cooperation influenced markets worldwide and contributed to imbalances that would later fuel the Great Depression. When the Depression struck, the rigidity of the gold standard became unbearable. Britain abandoned gold again in 1931, exposing the failure of monetary orthodoxy. Yet paradoxically, the bank emerged from the crisis even more essential. Whenever panic hit, it was the institution everyone turned to. Its authority, built over centuries, now seemed indispensable. During the Second World War, the bank operated hand in hand with the government. Monetary policy and fiscal policy became intertwined, as the bank created money to support wartime spending. After the war, the global financial system was restructured. The US dollar became the new anchor of world trade, yet the Bank of England remained a central player. In 1946, it was formally nationalized, but the internal culture and decision-making structures largely stayed the same. The bank still wielded influence through the City of London's vast financial networks, which extended deep into former colonies. In the post-war decades, London became a magnet for global money. Offshore markets flourished, and the Bank of England quietly supported their growth. Even as the British Empire faded, Britain maintained financial influence through credit, investment, and currency markets. Control no longer relied on territory. It relied on money flows, and the bank played a key part in directing them. By the 1970s and 80s, new financial instruments, volatile markets, and global shocks challenged the bank's traditional tools. Yet its role during crises remained the same: step in, stabilize, and guide the system back to order. This pattern repeated during the 2008 financial crisis. Though the turmoil began in the United States, Britain felt the impact immediately. Banks faltered, credit froze, and the economy stalled. The Bank of England launched massive interventions, from emergency lending to quantitative easing, creating new money to buy government bonds. These actions reshaped mortgages, pension values, and job markets, often without the public fully understanding the mechanisms behind them. The bank's influence extends beyond economics. Governments design budgets with an eye toward how the bank might react. Interest rate expectations influence everything from house prices to diplomatic negotiations. Through regulations and oversight, it indirectly shapes decisions made by commercial banks, investment firms, and global institutions. Its power works quietly, guiding the financial system through signals, expectations, and strategic discretion. Public communication from the bank is deliberately measured. Reports are technical, speech is cautious, and key discussions occur behind closed doors. This creates the impression of neutrality, while preserving its authority over monetary decisions. Too much transparency could provoke political backlash. Too little could undermine trust. The institution walks a careful line. Across 3 centuries, certain patterns repeat. Crises justify intervention. Wars expand debt. New technologies force adaptation. But the bank's underlying function remains the same: manage the flow of money, maintain stability, and quietly influence the system from within. Its endurance through wars, recessions, and political upheavals is no accident. It reflects a structure built to preserve authority over the financial lifeblood of the nation. Today, the bank faces new challenges: digital currencies, decentralized finance, environmental risks, and global economic shifts. Yet the institution continues evolving. Just as it once embraced paper money, national debt, and electronic markets, it now explores digital forms of currency and new regulatory tools. Whatever changes come, its central role persists. Those who shape the creation and distribution of money still wield immense influence. The story of the Bank of England is more than a history lesson. It's a guide to understanding how modern financial power works. Money is not just currency, it is a system of control. And for more than 300 years, this institution has stood at the heart of that system. Every major economic transition, every crisis, and nearly every financial turning point has involved decisions made behind its doors. The bank's legacy proves a simple truth: understanding who controls money is essential to understanding how the world works.